Now starting. All attendees are in listen-only mode.
Hi, good morning. Thank you all for joining us today for Thinking About or Recently Divorced, Be Financially Smart. For those of you joining us for the first time today, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. I've been with the firm for almost 4 years now, and my primary role includes client service, marketing, and compliance. I would like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be assisting David today and monitoring all these questions, and will ask David to answer as many as the time allows at the end of the webinar. But if we do run low on time and we're unable to get to your question, David or myself will reach out to you directly after the webinar to make sure we can get your questions answered. Now I'd like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor, bringing with him over 20 years of experience in financial planning and wealth management. Prior to joining our firm, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. David also serves as a member on our firm's investment committee. Thank you so much for joining us today, David.
Amanda, thank you very much, and welcome everyone. Good afternoon. Thank you for joining the webinar today. We have a lot to get to today, so I'd like to jump right into the material today. The divorce concept is certainly not a pleasant concept for people that are going through it, but there are many important items to be aware of that would encompass emotional, legal, financial, and it's important to really seek the advice of people that can help in many of those areas. So we want to spend some time today talking really about the financial ideas and concepts that we would want people to be aware of going through a situation like this. So I want to get started by talking about pre-divorce considerations, things that you want to think about if you think that you're heading into a situation where your marriage might be ending. The first point is to really consult to get legal advice. There is not a requirement to have an attorney to go through a divorce. Folks can do it on their own. But we feel that with the many legal aspects that come into play, it's important to seek proper legal advice. And, you know, there are a handful of key do's and don'ts that an attorney will advise you about to make sure that you're in the best position before you get started with the process. The other important thing is really to try to copy important documents. If possible, go through your household files and make copies of everything you can find, including the list that's shown here. If your spouse happens to be self-employed, it's really important to gather as much information as possible about the finances of the business, and make copies of any financial data that might be stored on your computer or other places in your home. It's also good to do a home inventory. You know, since you and your spouse will be dividing all property, it's a good idea to do an inventory of major items like furniture, artwork, valuable jewelry, appliances, and other things. And make sure to include any on-site or off-site storage facilities, and also consider things like safe deposit box at your bank. And really try to list your household budget, including any expenses. You know, knowing your household budget and weekly, monthly, and annual expenses you and your spouse typically incur is really important in this process, because this information may be useful when a judge or mediator is considering things like alimony and child support. You want to analyze the family debt, and if possible, try to determine what the family debt is and really consider paying it down before the divorce proceedings. Allocation of marital debt among spouses is really one of the most difficult items to try to negotiate during this process. And while taking stock of the debt, try to determine whether any of the debt was incurred by one spouse or the other prior to the date of the marriage. This would be considered non-marital debt, and it belongs to the spouse who incurred it. So that will be important as you're going through the process. And really find out how much your spouse earns. If possible, it's a good idea to find out exactly how much money they make. If they have a job that pays a regular salary, look for a pay stub. In some cases, if your spouse is self-employed or owns a business or receives any portion of income in cash, do your best to try to keep track of the money flowing in for a few months. Unfortunately, it can be common for one spouse to try to hide the amount of money they earn in order to reduce what might end up being an alimony or child support payments. And really try to assess your own earnings potential. If you've been out of the workforce for a long period of time, it's a good idea to get an idea of how much you'll be able to earn if you do re-enter the job market. Your earning potential will likely be a key point of contention during the process, so it's a good idea to be familiar with where you stand. And really, it's also important to know your credit history and rating. If you think it's likely that you'll be moving out of the home, it's crucial to know your credit history and current credit score. It's almost impossible to acquire a new home or a car or even sometimes a new cell phone without good credit ratings. So if you have poor credit or no credit history, the sooner you can start taking steps to remedy the situation, the better off you'll be. Divorce is really ultimately about dividing assets, and therefore, of course, having a complete list of these assets is extremely important. There are several resources you can use to help gather assets and liability information. A financial affidavit is one way to do it. Some states might call it by this name. Some states refer to it as a different name, but really it's a way to list all assets. And these types of lists do a good job of identifying and quantifying most traditional financial assets such as bank accounts, retirement accounts, and life insurance cash value, and of course liabilities including loans and credit card debt. These are some additional items that you'll commonly see that you'll have to report on these financial affidavits or financial surveys. So the courts will really use this financial affidavit when deciding things like alimony, child support, including any temporary alimony or support, and the division of property. So it's crucial that these numbers included are accurate. And as with many aspects of divorce, it's going to differ depending on where you live. So a lot of the laws and the regulations that come into play with this process can really differ from state to state. So generally, and that goes with everything that we're saying here today, generally what we're talking about here today will be what you'll most likely see, but there are going to be some variations in the regulations from state to state. When you file your financial affidavit, you must swear under oath that the information you provided is true and correct to the best of your knowledge. Anyone who submits false information on one of these affidavits can be held in contempt of court, and there could be some possible criminal charges. Of course, the financial affidavit can and often will be revised, but just because it can be revised, you want to make sure that as you're revising it from the initial point in any revisions that the information is going to be accurate to the best of your knowledge. However, there are always going to be times when items that don't fall neatly into the definition of assets and liabilities, and they may be overlooked in the divorce process, meaning that they're overlooked or not disclosed on those financial affidavits. So capturing these assets can be difficult if you don't know the right questions to ask or the right places to look. So most people are not really trying to hide assets, but they just don't consider some of their holdings to have a significant worth or value, and they actually have no idea that something like a country club membership has value. So there's a list of assets to review that covers more potential items of value than the traditional forms. So things like tax refunds, most people don't think of this as an asset, but it can be the same as cash in the bank. You're going through a divorce process and you're listing assets, but it might happen to be in between the time you filed your taxes and you're waiting for a tax refund. So that refund is going to be coming back into the marital assets. So there could be things like rewards points, airline miles, hotel points, credit card points, things like a capital loss carry forward. There may be some big investment losses that the couple had in a prior year, and they're able to be using up these losses over a period of time, multiple years, where they can use these losses to offset taxable gains. So it's important to be aware of that. There might be deferred compensation, and deferred compensation can sometimes be an out of sight, out of mind type of thing. So it may be compensation that one spouse is going to be receiving at a later date, and it might not have been reported on any financial affidavit or survey. There could also be things like pensions from a previous job. There could be retained earnings. If one party owns a company, he or she may be entitled to retained earnings, which or could be withheld within the company. It could be a portion of the company's profits that were kept inside the company instead of being paid out. So it's important to be aware of situations like that. One spouse may be trying to delay a bonus or a pay raise, putting that off so that it doesn't show up in the family's assets. So it's important to try to understand if any of those situations are present. So in some circumstances, a lifestyle analysis may be ordered by the court to try to determine if they can match income and spending with the lifestyle that the couple is living. So if in some cases where the lifestyle analysis is done and things look out of sync, then the courts may be looking to gather some more information from the couple to try to reconcile the lifestyle with the assets that are shown. There's generally going to be two different ways that states are going to look at dividing assets in a divorce process. So you've got community property states, and in these cases, the two spouses have what's considered separate property, and that's not subject to division by the court. So generally, separate property is defined as any property owned before the marriage or obtained by inheritance or gift during the marriage. So in those states, everything else is considered community property, and it will most likely be subject to a pure 50-50 split. The other type of state is a equitable distribution states. And in these states, the couple's property and assets are considered marital property, and they're subject to be divided between the husband and wife equitably or fairly. But note that an equitable division of assets does not necessarily mean equal or 50-50. It means equitable or what's considered to be fair in the views of the courts. Massachusetts, for example, is an equitable division state when it comes to dividing assets in a divorce. And in Massachusetts, marital property includes all items, interests, possessions obtained by a couple during the marriage. However, Massachusetts does not consider property that's acquired by either party before the marriage to be marital property. Property acquired before the marriage is usually considered separate property that is not divisible by the court. So that's kind of similar to community property state, but it doesn't strictly follow that. Massachusetts and some other equitable division states, separate property may be considered marital property in certain circumstances. For example, consider a situation where there's been a long-term marriage and one spouse may have entered the marriage with significantly more assets than the other spouse. The couple may have become accustomed to a certain standard of living because of those assets during the marriage, and therefore the judge may consider some of that separate property acquired before the marriage to be actual marital property and subject to dividing that. So the goal really is to achieve a fair and equitable division of the assets. So it's just really, the takeaway is just understanding that in equitable distribution states, the courts are really going to look to have an equitable distribution. So they may or may not consider some of that separate property that was acquired prior to the marriage. But in community property states, you tend to see more of a straight 50-50 split of everything that is not separate property. So let's look at an example here to try to see how an equitable distribution state might work in dividing assets. So let's consider our couple here, Ross and Rachel. They've been married for 30 years. Rachel has stayed home and taken care of their 4 children. Ross earns about $165,000 a year, and he also started a side business out of their home to try to generate a little extra revenue when he eventually retires. He estimates that business to be worth around $80,000. They own their home, which is worth $350,000 with no mortgage, and Ross has a retirement plan at work worth about $250,000. They have savings and investments owned jointly of about $40,000, and their debt is just an auto loan with a balance of $5,000. So here's how their equity situation looks right now. So their assets total $730,000 minus the debt. They have total marital assets in this case of $725,000. So assuming a 50-50 split, they'd each receive $365,000 of assets, and then they would split the debt, each taking on $2,500 of debt. However, splitting assets down the middle is not often the most equitable or even the most feasible. So consider how this might play out. Rachel really wants to stay in the house, and Ross agrees to this, but in turn, he wants to keep the full value of his retirement plan, the savings and investments, and his business. He also agrees to assume the debt. In this case, the property division would be as follows. We put the house in Rachel's column, and we put everything else in Ross's column. So with this, Ross's assets would total $375,000. It's $380,000 of assets minus the $5,000 of debt, and Rachel's assets would total $350,000. So really, if we wanted to create a 50-50 split, Ross would owe Rachel $12,500. That would bring both of their assets up to an equal 50-50 split. But Ross really doesn't want to give up any of his retirement plan, and he really wants to keep the savings and investments. His business is not liquid, so that really can't be split. So one way to even this out would be through what's called a property settlement note. And the way that a property settlement note would work, it's used to equalize the division of assets. So it can be effective in cases with illiquid assets, such as a home or a business. And really the way that these work is the spouse that ends up with a larger amount of the assets at the time of the split, they end up making monthly payments from that spouse to the other spouse. And really what you do is you set up this property settlement note where you're using a prevailing interest rate. It's considered a non-taxable transfer of assets between the spouse, because remember, we're just accomplishing a further division of the assets. So the transferring of the value of the assets would not be taxable, but it would only be an interest portion of each payment would be taxable. So maybe this property settlement note takes, let's say, 5 years to pay out. So one spouse is paying another spouse in cash over a 5-year period, and because of the interest rate is used, just that interest portion is going to be taxable to the person receiving it. But the portion of that payment that's considered the part of the marital property would not be taxable. But it's important to look at whether these property settlement notes make sense. For instance, if the assets were split so that Rachel ended up with more than Ross, it really wouldn't be feasible to execute a property settlement note for Rachel to pay Ross, since she doesn't work and didn't get any liquid assets in this division. So it'll be difficult for her to make these payments. Also, providing Rachel with some of Ross's retirement account could be another way to equalize the division in terms of dollar value, but Rachel would have to pay taxes if she withdrew this money. And since she's only 55 years old, she would also have to pay a 10% early withdrawal penalty, since she'd be withdrawing assets from a retirement account prior to 59 and a half. So a more reasonable settlement would really be to split the savings and investments, so Rachel would really end up with some liquid assets available to her. So one way might be splitting these savings and investments 50-50. That would leave Rachel with $375,000 and Ross with $350,000. So opposite of the way we showed it in our example. But the parties and especially a judge may decide that this unequal division of assets is the most equitable. So again, just getting back to what we talked about a moment ago, there may be a unequal division of assets in terms of the dollar value, but it could be considered equitable because the judge views it as making the most sense. So in this case, they're looking at it saying, okay, Rachel's getting the house, but she hasn't worked, so it might take her a while to get back into the workforce. Ross wants to keep these other assets, but it makes sense to have them split the liquid assets 50-50 so they at least have some money up front. So very important to remember that in equitable division states, equitable doesn't mean equal, it means fair. So further considerations for dividing assets. It may seem logical as a starting point to look at each asset and assume a 50-50 division of each account or each piece of property. However, it's not always practical to split the assets in this way, especially with a home or a family-owned business, assets that can't be easily divided in value. So consideration should really be given to the long-term effect of the division of assets. For example, suppose one spouse gets all the assets that appreciate slowly or even depreciate and cost money to maintain, like a home or car or furniture, while the other spouse receives all of the assets that appreciate in value or even produce income, like investments or retirement accounts or a rental home. In this case, what may appear to be an equal division at first could potentially produce a wide gap in the net worth of each spouse a few years after the divorce. So in Massachusetts, the divorce laws stipulate that there's really 14 factors that have to be considered when arriving at a divorce order for an equitable division of the marital assets. So it's things like length of marriage, conduct of the parties during the marriage, age, health, lifestyle, occupation, the amount and sources of income, vocational skills, employability and liability and needs of each party, and also the opportunity for each for future acquisition of assets and income. So there's a lot of considerations that a judge must consider in Massachusetts. But although those factors must be considered, a judge has substantial discretion as to how much weight is afforded to each factor, if any weight at all. So there may be a judge that has to consider all these factors, but really doesn't put any weight in one of them. So, you can start to see where things are going to vary from state to state. But additionally, judges in Massachusetts may also consider two non-mandatory factors that can have an impact on the property division on a case-by-case basis. These two factors are the contribution to the marital estate and the contribution as a homemaker. So contribution to the marital estate, meaning the assets that a spouse brought into a marriage, as well as a spouse's financial contribution to the marital estate during the marriage. And of course, contribution as a homeowner, homemaker can be considered as well. So, but it's also important to note that in a divorce situation that involves a family-owned business, it's important to have the business value determined by a certified appraiser, someone who's been especially trained to appraise businesses. Now, one of the bigger items that's commonly divided in a divorce, because it can usually represent one of the largest financial assets that a couple can have, would be a retirement account. And to divide a retirement plan, it's necessary to have a quadro, or a qualified domestic relations order, commonly referred to by its acronym. So usually people will refer to it as a quadro. A quadro is an order from the court to the retirement plan administrator spelling out how the plan's benefits are to be assigned to each party when there's a divorce. But first, let's clarify the difference between qualified plans and other types of retirement accounts. A qualified plan is an employer-sponsored retirement plan that qualifies for special tax treatment. So the most common plans are going to be 401ks and 403bs would be the most commonly what you would see as a qualified plan that's going to be divided using a quadro. Remember that IRAs, including Roth IRAs and simple IRAs, are not qualified plans. So what we're talking about here are not going to be ways that an IRA is split here. I'll talk about that in just a moment. So important to note that a quadro really can't require a plan to provide any form of benefit that's not otherwise provided under the original plan document. And it can't provide a benefit, it can't require a plan to require an increased benefit. So a quadro is a very specific document that will instruct the plan, the company that's holding the benefit plan. It'll instruct the plan on how to distribute this plan to both parties. So we can have things like defined contribution plans like a 401k or 403b. Those are really going to be easier to divide since they have a cash value that's determined daily. So in some cases, companies allow an account to be divided so that the ex-spouse also has an account with that retirement plan company as well. Otherwise, when the asset is divided, the value can be transferred to an IRA for the ex-spouse without triggering any tax consequences. For defined benefit plans, such as a pension, the division of the asset is a little more complicated since a pension plan may define an amount of monthly benefit that the recipient is to receive in retirement, but the plan may not have an account balance today. So these plans can also be divided equally or unequally by using a quadro as well. And if the parties agree not to wait until a later date to divide that asset, then it must be valued today. And to determine the current value of a defined benefit pension plan, a calculation is done to value the future stream of income down to a present value. So let's say that someone is to start to receive a payment out of a pension plan when they retire at 65, but the individual is only 55. So we do a calculation is done to determine a present value of that future stream of income. And that present value is just simply added to the list of marital assets to be divided. So you remember a moment ago we had a list for Ross and Rachel, different assets to go in one column or the other. Pension that we look at a present value for is just simply put in the list of marital assets subject to be divided. So it is important to note, though, that when dividing something like retirement accounts and pensions, some states will look at the balance of the retirement account accrued prior to the marriage as not being divisible. So again, that's going to vary from state to state, and just important to be aware of how that's going to work. For example, in the example we showed with Ross and Rachel, assume that Ross had worked at his company for 20 years and had been married to Rachel for 15 years prior to the divorce. In that case, it may be viewed that only 3/4 of the pension's present value is considered a marital asset to be divided. Drafting a quadro as early as possible is very important. The employee's company must approve the quadro, so you really want to know as soon as possible if they will accept the instructions in the quadro. It can take months for a company to review and respond, so starting early is really important. There are other details that are important to include too. The document should include instructions for providing payments to the spouse if the employee dies or remarries, and it must be drafted in a way that complies with the plan's normal payout rules, as I mentioned a moment ago. So given that there can be a lot of nuances and details, it's important to get that document started as soon as possible. And the manner in which the pension is split depends on the specifics of the plan. So some plans, for instance, may allow for separate interests in which the pension is divided in two, and each spouse controls their own account. In some cases, that's not possible, and as I mentioned, the present value is used, and then a division of assets is based off of that. Lastly, on this point, just as a reminder, a quadro is not needed to divide a IRA. So an important thing to be aware of is there can be an exception to the 10% penalty. A moment ago, I talked about with our example of Ross and Rachel, if we were to split Ross's account, his 401k account, let's say that we determined we were going to split that 50-50. Rachel could take her portion of that 50-50 split and just simply transfer that over to an IRA. You know, she doesn't work at that company, so in this case, the company says, well, we only allow a 401k account for an employee, but subject to this quadro, we'll let Rachel take her half, and then she can go over and open up an IRA at a different company. So I mentioned that if Rachel wanted to access money from that, she would have to pay an early withdrawal penalty because she's only 55, and the rules say that accessing qualified plan money prior to age 59 and a half, not only is it taxable, but there's an additional 10% penalty. But there is a special exception to the 10% penalty in situations where there's a divorce. So the penalty exception gives a divorcing couple a unique opportunity to access the retirement money without the penalty. And the way that the regulation works is it states that when you take money out of the qualified plan in accordance with a written divorce instrument, like a quadro, the recipient can take a portion or all of it without paying the 10% penalty. The recipient would still have to pay the income taxes, but the penalty tax is waived. So let's look at an example of how this would work. Because there's very specific rules to be mindful of when you want to try to do this without incurring the 10% penalty. So let's say Sarah was married to an airline pilot who was nearing retirement. They were both age 55. There was $640,000 in his 401k, and it was determined that the retirement plan was to be split 50-50. So Sarah was going to take $320,000 over to her IRA. So she could transfer the money to an IRA and not pay any taxes until she withdrew the funds later. But Sarah realized that her attorney's fees were $60,000 and she needed another $20,000 to fix her roof. So she could really use about $80,000. And because Sarah mentioned this need for the money before the divorce was finalized, the attorney was able to include language in the quadro that instructed the 401k plan administrator to make the withdrawal before transferring her half of the 401k to an IRA. So since there's a requirement for the administrator to withhold 20% for taxes, Sarah asked for $100,000. So after the 20% withholding, she ended up with the $80,000 in cash, and then $220,000 went over to her IRA. So she was able to spend the $80,000 without incurring that 10% penalty. But remember, she had to take out $100,000, and there was a 20% withdrawal for regular tax. But she didn't have the additional penalty, so that saved her $10,000 in penalties. But be aware that after the money from the plan goes into an IRA, which is not considered a qualified plan, Sarah would then be held to the regular early withdrawal rules. So if she says, oh, I forgot, I need another $5,000 to buy a car, after it goes into her IRA, it's too late. She would have to pay the 10% penalty and the taxes. So when a divorcing spouse is under age 59 and a half, this can be a really useful strategy since his or her access to retirement money is subject to the 10% penalty. So it could be a nice planning tool if someone has a need for cash and there's really no other way to get it, or there weren't enough liquid assets available to each spouse. Again, just to be mindful of this, because this is an error that's made quite often, that dividing an IRA in divorce, a quadro is not required. It's a little bit easier to divide an IRA. There's no tax when money is transferred to an ex-spouse due to a divorce with an IRA, and the recipient spouse can transfer those assets to their own IRA. So normally the company that's holding the IRA, they would just need a divorce agreement or document just indicating that the account's going to be split incident to a divorce, and then the recipient spouse can open up their own IRA. But hold on, what about inherited IRAs? Inherited IRAs are a different type of IRA, and they really have their own set of rules, so they're treated differently than a regular traditional IRA. So an inherited IRA applies to situations where an IRA is inherited from a non-spouse. So they can still be divided in a divorce, but there really are special considerations with this type of an account. So it's important to be aware of all the rules that come into play. So to illustrate how this works, let's look at an example. Let's say Sarah, at age 45, inherits an IRA from her father. So as we said, with a non-spouse inheriting an IRA, this now becomes an inherited IRA. So Sarah cannot contribute to this IRA, and she can't commingle this IRA with her other IRA accounts. So she may already have her own IRAs, but this inherited IRA cannot be commingled with her other IRA accounts. In addition, she's also required to take a minimum amount out of this account every year, regardless of how old she is. So the amount she must withdraw is based on the account value and her age. So other than that, she can invest the money or take other distributions above the minimum amount, however she wants. So as with other IRAs, each distribution is taxable to her at her ordinary rate. So let's say 5 years later, after Sarah inherits her father's IRA, she and her husband Steve are getting divorced. Sarah's inherited IRA can be split or awarded to Steve, just like a traditional IRA. But for the portion of the account that Steve receives, remember, he could receive a portion of it or all of it, but for the any portion of the account that Steve gets, he steps into the shoes of where Sarah was, that original non-spouse beneficiary of the account. So just like Sarah, he'll have to take a required minimum distribution each year, even if he's under the traditional minimum retirement age of 70 and a half. But here's the key point. The distributions that Steve will take will still be based on Sarah's age, even though Steve is the new account owner. So that's one of the tricky parts of all of this. So the potential for errors in this situation are many. So first, Steve has to know that he can't combine the inherited IRA money with his own IRA. He also must be made aware of his obligation to take an annual distribution, and that he must, calculate the proper amount so that he doesn't miss this really important requirement. He could be penalized by the IRS if he misses that required distribution, or if he doesn't take out enough to meet the distribution. So it's important to be aware of all those issues with a inherited IRA. So let's talk about selling the family home in a divorce situation. So the tax implications of selling a family house in a divorce can be a little complicated, and the timing is everything, especially if there's a potential for capital gain. So just to review here, the current rules allow for a single homeowner, a single tax filer, a homeowner to exclude up to $250,000 of gain when they sell the house from capital gains tax, and the exclusion for a married couple is $500,000. So simply double that for a married couple. However, it's still possible for both spouses to take a $250,000 exclusion individually, even though one spouse is awarded the house and the other spouse has been out of the house for several years. But to do that, they have to pass two important tests. One would be the ownership test. So if one spouse, pursuant to a divorce decree or a separation agreement, is required to grant the other spouse the right to temporarily possess the house, but that house that the spouse that's leaving the home retains title to the home, and then the home is later sold, that non-occupying spouse will be treated as having owned the home for the period of time that the occupying spouse owned the home as a principal residence. So even though, let's say, the husband had to move out and the wife stayed in the home, as long as their names both stay on the title of the house, then both spouses can each use a $250,000 exclusion on capital gain when the house is later sold. The other is a use test, and the ownership and the use test means that you have to have owned and used the home in 2 out of the prior 5 years before selling it. So as long as those tests are satisfied, you can use the exclusions to capital gains that I mentioned. So it's important to be aware of this, because oftentimes the marital home is sold, so there can be some confusion around who can exclude gain and which spouse is able to do that. So let's look at a little mini case study here. Robert, in this case, Robert and Kathy are getting divorced, and under the divorce decree, Kathy is awarded the jointly owned family home for 6 years until their son graduates from high school. So in this case, the home will remain under joint ownership, and at the end of the 6 years, Kathy will sell the house and give 50% of the proceeds to Rob. So we're looking at a situation where the home is sold for $600,000 and they each receive $300,000. So as we said, they each receive $300,000, but the cost basis in the home was $100,000. So Kathy's portion of the basis is $50,000, leaving her with a $250,000 gain. In this case, Kathy will be able to use her $250,000 exclusion and have no taxable gain to report because they satisfy the ownership and the use test that we talk about. Rob is also able to deduct the $250,000 from his share of the gain, even though he hasn't lived in the house for 6 years. So he will also have no taxable gain on the sale. But again, in a divorce situation, for this to work, both names have to stay on the deed so that the IRS knows that Rob is entitled to his exclusion. The arrangement also has to be stated in the divorce decree that this is how this is going to be set up. Another nice feature of this tax law is that it's not a one-time exclusion. So individuals can use this over and over again, really, as long as they satisfy that ownership and the use test, meaning that they would have to have owned and used whichever home they're selling for 2 out of the previous 5 years. So the point is you can do this for subsequent homes that are bought and sold. So it's an important item to be aware of. Many people assume that the individual who has moved out of the home is not able to exclude that basis if the home were later sold, but it is possible to be able to do so. Something else to be aware of, and in this case, we're coming down to the wire here at the end of 2018, so the clock is ticking here, but there's a new tax rule related to divorces. This came out of the Tax Cuts and Jobs Act that was passed about a year ago at this time, at the end of 2017, and many of the rules in that act went into law for 2018. And in this case, the part of that law that impacted divorce situations was related to spousal support or alimony payments. And so probably one of the most important aspects of the bill for divorcing couples is this removal of the tax deduction for alimony payments for divorces that are finalized after December 31st of 2018. So when this rule does take effect, the alimony paying spouse of a couple will no longer be able to deduct the alimony payments from taxable income. And on the flip side, the spouse who's receiving the alimony won't have to declare it as income. So this, again, applies to a divorce or separation agreement executed after December 31st, 2018. So any divorce or separation agreement executed on or before December 31st of this year will be grandfathered in, and provided that the parties involved have a written separation agreement by that date. So this means that as long as an agreement is reached prior to the deadline, the paying spouse may still take the alimony deduction, and the receiving spouse must still report the alimony they receive as income. So there's been a little, I guess, a little confusion, I would say, on this rule. A decree of divorce need not be acquired by the deadline. Just a written separation agreement is sufficient under the law. I have read and seen recently that some commentators are taking a little bit more of a stricter interpretation of this law, saying that a divorce must be finalized by this date. And again, some are saying that they just need a written separation agreement is sufficient. So obviously, folks that are going through a divorce that are being mindful of this deadline are in a situation where they'd be coming to an important date here at the end of the year. So they're going to want to get really some proper legal advice as to how each individual states are going to be looking at this. So any divorce really that happens in 2019 and beyond, the alimony payments won't be taxable to the recipient and not tax deductible for the individual that's paying it. So we are there is another question mark that's out there, and really it's related to existing alimony agreements can be amended to fall under the provisions of the new law, but it's unclear at this point whether modifications that are made to a divorce agreement after December 31st, 2018, it's unclear whether they'll cause the agreement to lose its grandfathered status. So in other words, there may be a divorce agreement that was already made final, and the parties would be under the guise of looking at grandfathered tax status of those alimony payments. But in some cases, an alimony agreement could be modified after January 1st of 2019. And it's possible that because they modify the agreement after that deadline, it might result in the new tax treatment being applied to the alimony payment. So, until the IRS provides further guidance on this matter, which is expected, it's important for people to really consult with their legal advisor on this. So speaking of alimony payments, those payments and child support payments are usually very important parts of divorce agreements. And, there may still be some financial dependence on spouses even after a divorce. And I want to take a couple minutes to talk about how life insurance can apply in these situations. Life insurance is traditionally purchased to cover the risk that one spouse in a marriage might die during the marriage and leave that surviving spouse unable to support his or herself But when the couple divorces, you might think that the risk no longer exists as the two parties aren't really dependent on one another. But there are several reasons why life insurance may still be necessary. And that can bring up some different issues. So the most common use of life insurance is to secure an alimony or a child support payment. The payee spouse would lose these payments should the payer spouse die. So it's important to consider that it might still be useful to have life insurance on the spouse that's paying the alimony, so that if something happens to them, the spouse that's receiving the alimony payments would be protected in that case. It's advised in these situations to have the spouse that's receiving the alimony payments be the owner of that life insurance, so that they can ensure that the premiums are being paid and that the beneficiary isn't being changed. They want themselves to remain as beneficiaries so they can receive it. They don't want the other spouse changing the beneficiary to someone else or maybe a new spouse. So in some cases, the life insurance may be court ordered, and in that case, they're not able to change the life insurance. So the important takeaway is before someone decides to give up any of their life insurance, it could be important to consider that this might come into play in the divorce situation. So Social Security also has some special rules related to divorcing couples, and it's still possible for individuals to maximize their benefits. So the first step is really try to get a current estimate of both spouses' benefits at really 3 different ages. Ages 62, when you can first start to get a benefit, and then again at full retirement age, and then at age 70, at which time a person's benefit maxes out. So it's really important to get those estimates of benefits. And spouses can qualify for benefits off of an ex-spouse's record, but certain conditions have to be met. And really, all of these following conditions have to apply. So for a spouse to get a benefit off of their ex-spouse's record, the ex-spouse has to be currently eligible to receive benefits, meaning that they have to be at least age 62, which is the age where you could start to receive benefits. Note that ex-spouse does not have to claim their benefit. They just have to be eligible to receive it. The marriage has to have lasted for 10 years before the divorce is final. And you have had to be divorced for at least 2 years. And you cannot be currently married, so you can't be remarried and get benefits off of your ex-spouse's record. And you yourself have to be age 62 or older. And you also can't qualify for your own benefit that might be higher than half of the ex-spouse's. So you'd be entitled to your ex-spouse's benefit, but you'd get half of what they receive. But if you have your own Social Security benefit that's higher, then you're going to end up getting your own benefit. So looking at an example here, let's say that Dawn's benefit is $2,400 a month at his full retirement age. Mary also qualifies for her own benefit because she worked, and her benefit would be $1,000 a month at her own full retirement age of also 66. So they're the same age, but after they divorce, Mary waits till age 66. She's entitled to receive a benefit of $1,200 a month because they met all those conditions of their marriage, and now that they're divorced, she can receive half of his. So her own benefit would have been $1,000, but she can get $1,200 a month. Now she can actually start claiming at 62, but if she does, the benefits are reduced. So she would receive either the higher of her own benefit or a percentage of Dawn's benefit. She wouldn't receive half anymore because she would claim early. So important to note that benefits will be reduced if you claim early. Now, there is one way that divorcing couples can still have an option here that's an important option related to these types of benefits. So a special exception to coordinating benefits is available for people who are entitled to both retirement, their own benefit, and spousal benefit, including ex-spousal benefit. But it depends on which year they were born. So this technique or this claiming strategy is called a restricted application. This was eliminated under the Budget Act of 2015, but it was grandfathered if the individual was born on January 1st of 1954 or earlier. So you have to have been born on or before that date to be able to do a restricted application. And what it does is it allows a spouse, including a divorcee ex-spouse, to file for any spousal benefits that they're entitled to, but only spousal benefits and not their individual retirement benefits. So this would allow a divorcee to say, I just want to claim the spousal benefit and I don't want to touch my own benefit. So you have to wait till your full retirement age to do this, and you have to be born on or before January 1st, 1954. And by doing this, you can allow your own benefit that you're not claiming to receive a delayed retirement credit, meaning that your own benefit would grow 8% a year up to age 70. So let's take a look at what this would look like in our example. Let's go back to Dawn and Mary. We said that Dawn's benefit at his full retirement age is $2,400 a month, and Mary's own benefit is $1,000 a month. So if Mary claims a benefit at age 66, the higher benefit is 50% of Dawn's, or the $1,200 a month. But what if Mary, who's eligible to file a restricted application based on her birthday, what if she elects to file the restricted application and only receive the ex-spousal benefit of $1,200 a month? She'll want to specifically state in her application that she's filing a restricted application. Then, at her age 70, she can switch to her own benefit that has received these delayed retirement credits of 8% a year, and it's now 32% higher than it was at her age 66. So her own benefit is now $1,320, and she can switch to that. So she claimed $1,200 a month for 4 years while leaving her own benefit alone. Her own benefit that started at $1,000 a month at her age 66 is now going to be $1,320 a month at her age 70. So it's potentially a way to maximize your benefit, provided that you're meeting all the other requirements. I want to take the last couple minutes here to really talk about post-divorce financial planning. And really, a comprehensive financial plan is important. Creating a post-divorce budget plan, and it's important to understand how each of these areas that we discussed today work together in your overall plan. You know, your cash flow determines what you can save for various goals each month. Your tax situation determines which kind of retirement savings account is best for you. And your long-term goals really impact the type of investment strategy you should choose. So, you know, really consider working with a trusted financial advisor who is going to operate in your best interest to make decisions in these various areas. And as you transition your life after divorce, taking steps to strengthen your financial situation can really provide a level of comfort that allows you to focus on your emotional health and well-being and that of your children and others that are close to you. So you're going to want to do a lot of these things just to make sure that you're in a good financial situation, as well as dealing with all the legal and emotional aspects as well. So that really wraps up all that I wanted to cover for today. There's as you can see, there's a lot of issues to cover. We could talk all day on these topics, but I wanted to bring to light some of the more important financial topics that are critical to be aware of, and potentially work with an advisor to make sure you're getting the right advice. Amanda, do we have any questions?
Hi, David. Yeah, we just have a couple. So for the essence and time here, we can just go through a couple. And if we don't get to yours, we certainly will reach out and make sure we get your questions answered. So the first one I have is, how is home equity split in a divorce?
Yeah, that's a good question. That really comes up a lot, considering most of the time the house is going to be handled in some way or another. And really, what will happen with the house is really going to depend on what the rest of your finances look like. So you'll each leave with assets that you have, which you brought into the marriage. And the marital assets, as I said, are really going to be split according to your state's law, which might say 50-50, or it might be an equitable or fair split. So depending on which state you're in. So how the court will decide about the house is going to depend on what else you have to divide, what income was brought into the marriage, and what funds you or your husband use for the down payment. So it's really going to basically be a asset that's subject to being divided with the rest of your assets.
The next question we have is, property given as a gift considered joint property?
Well, it possibly could be considered joint property. So if it was a gift to both of the husband and wife, then it is joint property. So that might be hard to determine. So as I mentioned early on, a gift to one individual in the marriage is usually going to be considered separate property. But there may be situations where the in-laws gave a gift jointly to both the husband and wife, and in those situations, if it was a joint gift, then it's going to end up being joint property. If it was a gift to an individual, then it will probably stay as separate property in almost all cases.
And the last question I think we have time for is, how do I protect myself if everything is in my spouse's name?
Yeah, that's an important point that comes up a lot in these situations, and really it's all going to be considered marital property, and it'll be divided. So even though things might just be in the husband's name or the wife's name, whatever name it's in is not as critical, because it's that the courts are going to be viewing it as a marital asset. So outside of something that you brought into the marriage, which might be considered a separate asset, most of the situations when you're married, if one spouse decides to open up a checking or savings account and they only put their name on it, the courts are going to view that as, well, you opened that account up when you were married, so we're considering that to be a marital asset that's going to be subject to be divided. So in most cases, someone shouldn't feel like they don't have any leverage if their name isn't on any of the accounts. In most cases, the accounts are going to be considered maritable property.
David, I think that's it for today. Thank you so much for all of this information. As always, thank you all for joining us today. Please look out for our 2019 calendar. It should be going out either this week or next week. We do monthly webinars on the important financial topics we're most asked about by our clients. So again, David, thank you so much for joining us, and thanks everybody. Have a great day.
Thank you. So long, everyone.